Thank everybody. We have Serge, Alex, Gleb, Abraham, and Maria here.
Awesome.
We have Susan, Craig, John from American Dream Title.
Thank you for breakfast.
Oh my God.
All of you, it's delicious. I'm making my way down the bell.
Yeah.
I started here, I'm gonna go here.
Appetizer, entree, dessert.
Thank you.
You're welcome.
I love Panera to be able to.
So shall we begin?
Yeah.
Okay. So how do you give, everybody's a realtor here, obviously. So is anybody have familiarity with the CFPB, the TRID rules that came into effect in 2015, the new closing disclosure, nothing? Okay, good. So this is what we'll talk about this today. I will first admit this is for informational purposes only. I'm not an attorney, I can't give legal advice. So I'm just gonna give you information. Obviously Susan is from American Dream Title, I'm from Old Republic Title, I'm her underwriter. She's on the front lines of this stuff, so she works with the closing disclosure and the lenders directly pretty much every day. So honestly, she's probably more the guru on this than I am. I'm gonna give you what the law is about, what it was intended to do, the spirit of the law, and then we'll go from there. But we like to be interactive, so feel free to ask any questions you might have. But again, I'm not an attorney. If you need legal advice, or your clients need legal advice,
We have a law firm.
they have a law firm too called Leopold Cohen PA, and I suggest you put people in contact with them. And again, this is for informational purposes only. So,
Inside your folder, you have this, we're gonna be following along.
this is the
with
PowerPoint we're going to go following along on. So,
Can you do one more for Alex?
yeah.
Oh, yeah. Here, I have one here. Here. Oh, you have there, okay.
And there's three things as part of this presentation. One is the PowerPoint, which we'll be going through. And the other two is actually the forms we're going to be discussing. One is the loan estimate, and one is the closing disclosure. The loan estimate happens in the beginning. The closing disclosure is at the closing table or prior to the closing table. And really, I think the closing disclosure is more where you're going to be involved with and what you're going to be kind of seeing. And honestly, I'll tell you some things too. Reason why, we'll get into that later on, but why only your client can actually give you a copy of the closing disclosure, and Susan or the closing agent or anybody else can't, because it's considered non-public personal information. And so if you ever ask a closing agent to please send you the CD or closing disclosure, I'm going to say CD a lot. It stands for closing disclosure. They're going to say to you, or normally will say to you, I can't send that to you. If you want a copy of that, please get it from your own buyer client.
Unless the buyer sends us a signed authorization, that we can release it, then we can.
But again, it's not on us. This is the law. So it's non-public. NPPI stands for non-public personal information. They consider the closing disclosure non-public personal information, and only the buyer, whose information it is, can share it with you. Okay?
You guys ain't gonna coffee maybe?
I'm good right now. So where did the CFPB come from? The CFPB is the group that was given power by the Dodd-Frank Act or bill that came around, and it gives them the power to enforce rules and levy penalties against the lending institution. And the rule also put the lenders responsible for everything that goes on in the closing process. They're now responsible for American Dream Title and what the agents do. So they also normally vet their agents, just like Old Republic as an underwriter vets our agents to make sure you're dealing with the right people who know what they're doing and do things right. It's a self-funded organization, the CFPB, so realize that, how do they exist? By fining. So they look for violations of the law, and they will fine lenders, and they have fined lenders to the tunes of millions and I think even billions of dollars for what they perceived as violations of the law.
What's it stand for? Consumer
Financial Protection Bureau.
Consumer Protection, yeah. So they took the TILA and RESPO rules and basically combined them, and they now enforce those laws. Now, TRID and the CFPB only relates to 1 to 4 family residential properties with lender financing, okay?
You guys, everybody know what RESP is, right? It's a disclosure,
It's disclosing everything, it's basically this, full disclosure, RESPA, making sure that you're not, remember the bait and switches? You can't bait and switch. So what the CFPB and the TRID came out of, I think, was what was perceived as the bait and switch that happened in the when everyone was so busy in the 2000s, and then we had the Great Recession, because there was a lot of, people were getting loans that really didn't qualify. You know, they're really, you know, financially, and two is that, you know, there was a lot of, you know, loans given where people didn't know what they were getting into. You had the negative AM loans where, you know, the payments would change. You just were rate loans where they had no idea, you know, 5 years later, their payment would go from $1,000 a month to $2,000 a month. And that caused a lot of, you know, obviously foreclosure. It caused a lot of the Great Recession.
The rents would climb, you know, 4 or 5%, and some of these people had first and second loans. It's crazy.
It was a crazy time, and so this is more of basically being upfront with the consumers or the buyers of what they're getting into, and to make sure they know what they're getting into and that they can afford the home they're purchasing, and they're aware of what will happen if they, you know, default.
There's many acts like on disclosures in the rest place one. I think it was in 1970s.
Yes.
Real estate settlement procedures.
Thank you. I was like, had a senior moment there for a minute, so.
You're senior.
Yeah,
Negative.
I'm getting there, so you
They
know.
have negative, Washington Mutual, who do they exist anymore?
They were brought up by, I think, they were taken
They
over.
had negative amortization loans, where you could literally have a payment so low that your mortgage balance was increasing every month.
You paid less than the interest-only payment, so actually every month your balance would actually go up because your payment was less than what the interest was on the loan.
Yeah.
So those are called negative AM loans. So you don't see too much of them now anymore. I haven't seen one in a while. So, but realize, you know, what I'm talking about today only applies to residential property. It does not apply to commercial property. It also doesn't apply to reverse mortgages. So if you're dealing with reverse mortgages, they are exempt from following these procedures. Doesn't apply to, again, commercial loans. HELOC, home equity lines of credit loans, do not apply to the TRID rules. Lender making 5 or fewer loans per year. Now, I've heard there's some discrepancy there, because there's one part of the rule that says 5 or few loans per year, and one that says 3 or few loans per year. So, to be on the safe side, you know, they're talking about seller finance. They're talking about, like, if you're making like 1 loan a year on your own part, they're kind of exempting those outside the box, non-institutional loans made by someone who's not really lending. Okay, so they don't necessarily have to follow the procedures. Now, again, this is legal. This is something that the lender or the private person giving the loan should really seek legal counsel on. I'm not going to tell them that they shouldn't follow these rules or not follow these rules. Okay, that's something they should get legal advice for. But the law itself does say lenders making 5 or few loans per year are usually exempt from having to follow these guidelines. But again, I'm not giving legal advice on that. Certain no interest subordinate special purpose loans. What are those? SHIP loans, the MAP HAP program. If you're not familiar with those, the government or the counties would give special loans to help buyers with offset closing costs. So they're almost like, you know, second loans or third loans sometimes, and they are not applicable. So if they're like government loans or the SHIP program or the MAP HAP program, they would be exempt from following these rules.
And most of those types of loans anyway, the interest gets forgiven if they're in the property a certain length of time.
Number of years. It's almost like a loan to close, and if you stay in the property for a while, it's forgiven.
Low income, first-time home buyer.
Yeah.
There are incentive programs to help low-income and first-time home buyers purchase property. The new
Guys,
dr-
they're all in the multi-million-dollar selling.
Yeah, I don't think you might not.
$5 million
Yeah, we find those
apartments
loans too
and
much.
all,
But, so let's talk about a few things. Just terms. The lender is now called the creditor. Okay. The borrower is now called the consumer. So if you hear these terms, the TILA and the GFE are now called the loan estimate. They merged those two documents into the loan estimate. And the TILA is the truth in lending application, and the GFE is the good faith estimate. And they merged that now into what's called the loan estimate. The HUD one is now the closing disclosure, sort of, and I'll go into that later on. And the closing settlement statement is now called consummation, so you consummate the closing. Okay. The first thing you want to think about your client. Okay, you get into a contract, they're going to get financing. They're getting a mortgage broker involved, and they're going to their bank. In order to get a loan estimate, all they have to do is provide the lender or the loan originator with 6 pieces of information. Okay, that is their name, their income. At this time, it's going to be stated; it's not being verified yet by the lender. Consumer's social security number, address of the property, estimated value of the property, which I'm assuming they're going to show the sales contract, and the mortgage loan amount that they're trying to get, the loan amount. Once they give that to the loan originator then has 3 days to provide that buyer with what's called a loan estimate, which will be basically this form here. It's gonna give them basic terms.
It's in your folder.
It's in your folder. And it's gonna tell them what, based on the information they provided, and then, obviously most likely running they're gonna run a credit report on the social security number on that buyer. They will then give them what they perceive as the loan terms. The loan amount they can get, the interest rate they're gonna be getting, their payments. It gives a little breakdown of the loan terms. It also gives them on the second page, the bank charges. Now, origination charges, I don't know if you remember back in the day, we had tolerance buckets. Certain things had a 0 tolerance, certain things had a 10% tolerance. Well, this would be like the 0 tolerance bucket from the old good faith estimates, where these fees are the bank's direct fees for doing the loan, and they can't really change. They can't change. Section B is services you can shop for. Again, you cannot shop for. These are things that are like third-party fees, like appraisals, credit report fees. Again, they're using the 10% range. They're gonna give you estimates here, but they gotta kind of stay within a certain threshold because you're not shopping. The buyer or consumer is not shopping for these. And then C is services you can shop for. Again, these would be, title, your title company you're gonna use, like let's say American Dream Title. They give you estimates here, but you basically will get this from your title company. Survey will also be in here. Again, the surveyor, you're shopping for that. Your lien company. City lien search right here.
That's right.
So basically, these are going to be in the section C. Again, the lender can't tell you directly how much exactly these are going to be, but they give you ballpark numbers here. They'll also give you estimated taxes and recording fees, prepaids, initial escrow payments at closing. Again, right now, these are kind of estimates, but they should be in the ballpark number. The problem is, depending on the day you close in the month, will affect what these fees are. Also, the final numbers will affect what these fees are. The final purchase price, loan amount, everything else. So, and the recording fees, you're estimating that here. I don't know what's gonna be needed. The deed is a 3-page deed or it's a 2-page deed. The mortgage 14 pages, 50 pages. Well, they might change a little bit. The things that are gonna be not changed are the loan origination fees or the bank's direct fees for doing this closing. So they must issue this to the consumer within 3 days of receiving the first 6 pieces of information. Now, the buyer now has 10 days to accept the loan and give confirmation to the lender they want to move forward, okay? If they don't give confirmation of this within 10 days, the process starts over again. So, if you have, and timelines in the CFPB TRID rules are very, specific and strict. So when you're dealing with a client that's getting financing, don't let them drag on this. They should be seeing, right after signing a contract, go to see, their lender or a mortgage broker or a loan originator and start getting the ball rolling. If they want to shop around, they should be seeing multiple, lenders then. Get this ball rolling early because remember, your contracts also have contingencies usually, financing contingencies, and you have timetables. Well, these laws have timetables too. So realize that if they go with the lender, make sure they give confirmation within that 10 business days that, hey, let's move forward. Because then that lender will go the next step and start, most likely, I'm not a lender, don't know the whole process, but I've seen it. And then they'll start verifying income, verifying employment, verifying all these things. So they give you these terms based on the basic information you gave them. But now they're going to start verifying what you gave them. Because right now it's stated. It's like saying, hey, I work here, I make $50,000 a year. Well, after you say I'm going to move forward, they're going to start verifying employment. If they find out you're making $30 a year, guess what? They can then reissue a new loan estimate or then decline the loan. So, now changes of circumstances occurring. Again, this is not in your tablet, in your PowerPoint. I'm kind of going off something else I'm also working with, but I apologize for that. I should have turned that off. Shame on me.
I did the same thing.
I'm gonna turn my other phone off too. I got 2 here, so that one's off again. Turn 1 out of 2 off. Okay. So information that where a new loan estimate could be, triggered is information specific to the consumer or transaction is inaccurate. Again, if you told them you made $100,000 a year and they do an income verification with your employer, you made 50. Well, guess what? They can now change your loan estimate. Extraordinary event beyond the control of any interest party or any other event specific to the consumer or transaction. Again, you all heard the saying: if you're applying for a loan, don't go out and buy a new car. Don't make any big purchases. Why? You don't want to mess with the whole, that'll affect your credit. So you want to make sure when you're applying for a loan, cease and desist, applying for credit cards, applying for anything else. Just till you close and you can do whatever you want. But, it's a smart practice, okay? Discovery of new info specific to consumer or transaction that affect the consumer's eligibility for the loan again. But let's say you do the appraisal too, and that comes in lower than your purchase price. Well, guess what? That's gonna affect your loan amount, and that's gonna affect the loan estimate. They can then change it. Revisions to credit terms or settlement requested by consumer, okay? If you're changing the loan terms, you were applying for adjustable rate mortgage and now you want it fixed, well, guess what? That's, loan terms will change and they can then reissue a new loan estimate. But typically, if everything is pretty much spot on what you supplied them and they can verify it, the loan estimate, I would imagine, again, I'm not a lender, but I would imagine that stays the same.
It speeds the process along if the information is accurate from the get-go, because then the lender doesn't have to do a new loan estimate. So you wanna make sure that your buyers understand that they have to be as accurate as they can when they're submitting their application.
Because they're gonna verify it.
Yeah.
I mean, so if anything's inaccurate, they're gonna find out, and hence, that's gonna change things, start the process over again, so realize that. And again, the last one is consumer does not give intent to proceed within 10 days of receiving the loan estimate. Guess what? The process starts over again. So again, these are timetables that have to be followed. So I suggest making sure you stay on top of the buyers who are getting financing, to make sure they're working with their mortgage broker or loan originator or lender to make sure that information is being supplied in a timely fashion. Now we get to the CD now, which happens at closing or right before closing, and most major lenders
That's in there too.
are preparing the CD, or close disclosure, in conjunction with the settlement agent through software portals or websites. Now, how are things going? Are the portals?
Both.
They're doing both.
Mhm.
So some are doing the portals where they're submitting their title fees and the premiums to the lender. The lender is generating the CD. They're having their fees, the title closings fees, everything else, and they're communicating through portals or websites. Others are still doing emails. Is that
Mhm.
correct? So some they'll say,
Secure
hey,
emails.
give me a pre-CD or give me your
Yeah.
figures and we'll put it in.
Exactly.
So.
The portals work best because it's instant communication, kind of like Dotloop, kind of how
Mhm.
Dotloop works.
Mhm.
It's a streaming communication with the lender, so it's much quicker, really.
So-
But not all of them use it. Wells does use it. A few of the big lenders do use it.
And now the reason why the lenders, for the most part, I've never really seen a lender ask a title company to actually send the CD to the buyer borrower,
No.
because there's very strict timelines here. And the lender must verify that the consumer or borrower receives the CD 3 business days in advance of the closing with limited redisclosure waiting period. Business days for CD purposes are every day except for Sunday and the 10 legal holidays. So Saturdays do count. As per CFPB, waiting period can be waived if an imminent sale of consumer's home at foreclosure and they need the proceeds from a refinance to stop it. Okay, so normally the CFPB will not really allow you to waive this 3-day rule unless, perhaps, if the buyer-borrower is not in a purchase sale transaction, they're in a refinance transaction, and if the refinance doesn't go through now, they're gonna lose their home. So they don't really care about the seller's situation. So if the seller's trying to sell a property and they're about to lose it in foreclosure, that's not a reason for the CFPB to allow you to waive this 3-day period. They don't really afford the seller any financial emergency stipulations. They only care about the buyer. So realize that if you're dealing with a short sale here and a foreclosure is imminent and you're trying to do a short sale or a sale to a buyer, they're not going to waive these timelines. So make sure if you're cutting the edge there, just make sure you get the ball rolling fast and make sure you realize these timelines here, because if the foreclosure sale is happening tomorrow and the CD hasn't been delivered to the buyer borrower till today, you have an issue.
Oh, yeah.
You're not going to make it because you can't close for 3 more days. So I'm just giving you an idea.
Then you have to get an extension and yeah.
So
But in case
we provide a nice little.
it's-
There's a nice little roadmap of when the CD is delivered and when you can close. Like, so if you wanted to close, let's say on a Monday, and there's 2 ways of this, sending the CD to a buyer borrower the lenders use. One is hand delivery, which is immediate delivery. So if I delivered it, let's say I delivered it today. Today's what, Wednesday?
Mm-hmm.
You could theoretically close on Saturday if we have proof that you received it today. Now, if I mailed it today, which the lenders could also do, the CFPB has a stipulation in there. Well, if you mail it and the lender has proof of mailing, 7 days you can close. So that means if I mail it today and the lender mails it today, we can close next Wednesday. So, and they don't have to prove you received it as long as they mail it. They have proof that they mailed it to you.
Most of them are doing email, obviously, to save time, you know.
And usually an email way, they're having you sign documentation at the loan estimate, when you're applying for the loan, that you are willing to receive it via email, and that this is the only email, you check it, you acknowledge it. So again, if they have proof that you received today, they can basically start the 3-day clock.
I think they need to confirm if they received it too, so.
Yeah, you'll probably reply back saying
They do
confirm.
an acknowledgement, yeah.
Doing it now. Yeah, they want acknowledgement for that 3-day clock. That means you
Yeah, it
acknowledge
starts
receipt.
with the,
Yeah. The other way is mailing it. Mailing it, they don't need acknowledgement. They have 7 days. 7 days they can close. So it depends. If you need to close fast, they'll email it, you acknowledge it, they can start the clock ticking. So there's there's redisclosure, 3-day, basically there's only 3 reasons why they'd have to redisclose and start the 3-day clock again. 1 is inaccurate APR. 2 is change in loan product, again, changing it from a fixed to adjustable. And 3 is if they add a prepaid penalty to the loan. They'd have to redisclose that CD. And then you have to start, now if they change minor changes which don't affect those items, they wouldn't have to redisclose, and you wouldn't have to wait another 3 days. Again, this is something the lenders are determining, not us. This is not in our purview. Okay, because remember the responsibility falls on them. So who's getting fined if something goes wrong? Them. Who's in trouble? Them. So they're gonna make the decisions on when you can close. It's not in our hands. So if they decide that a change that they do materially affects the CD in a way that affects one of these 3 things, they're gonna say, look, we're redisclosing the CD, you gotta wait 3 more days. But that's gonna be up to them, not us. Again, hand delivery is immediate. If you deliver on Monday, you can close on Thursday. US mail or email, typically they say it's 7 days or 6 days, 3 days to get there, 3 days to review it, then you can close. Just to go, the next slides, basically we go over the closing disclosure, which I like to let's go over it. Instead of going through the slides, let's just discuss it.
It's in your packet.
It's in your packet. Again, Susan cannot share this with you, okay? The lender cannot share this with you. It goes to the buyer-borrower only, and they can share it with you because it's their stuff, their information. So just don't feel bad or don't be upset with a title company or a law firm or that won't share the CD with you, okay? Because it's under the law they can't. So again, a lot of the terms on the first page should mirror the loan estimate. The loan estimate disappeared on me. But you'll see, the loan terms, they should match your loan estimate. So the interest rate, thank you. So you see here, these 2, this comes first. It's kind of like your loan estimate or good faith estimate of what the terms are going to be, and this should match it. So the first part, you're talking about the date issued. The date issued normally will be 3 days before the closing date. I know this is a bad example because
It's way before.
it's the same date, 4/15, and the closing date's 4/15. Well, technically that really can't happen, you know what I mean?
Yeah.
Now, it could happen if they do a revised one after the fact, and again, it didn't trigger in a new 3-day period. They could technically maybe do this, but again, this is coming from the lender. But typically, the date issued of the CD will be 3 days prior to, or 7 days prior to.
So it should be at least like 4/12, 4/15,
Yeah.
Exactly.
4/11.
Exactly, no, typically.
Typically, yeah.
But again, if they issue a new one at closing because something minor changed and didn't affect the
A name
APR,
spelling or,
Oh,
then they
yeah.
could
Yeah.
theoretically say it was issued again today, but it didn't affect the APR or one of the key
and
things.
that does happen.
That does happen. And so again, you have the settlement agent, you have the file number, which would be, really, that's gonna be, the file is really gonna be the title agent's file number.
Yeah.
The property address, the sales price. Realize on a refinance, you might still see a sales price there. You might go, why is there a sales price? It's a refinance. They put the appraised value there. So if you see a sales price there on a refinance transaction with the CDs involved, it's usually the appraised value that's there. The borrower information, seller information, lender information, give you loan terms here, 30-year fixed, purchase fixed rate, loan type conventional, FHA, VA, tells you what the loan is. Loan ID number, which is the loan number, and your MIC number. MIC number, if it's applicable, stands for mortgage insurance case number. So it's if the loan is subject to mortgage insurance, that will be here. If they're putting down enough where there's no mortgage insurance, it won't be here. You have your loan amount, interest rate, monthly principal interest payment, and you have little things here. Can this amount increase after closing? Well, it says no, no, no. Well, if it's an adjustable rate, mortgage being given at a fixed rate, this could be something to change. It would say yes. It would tell you usually, after 5 years, it could jump as high as this. Because it's based on usually points over whatever the prime is or whatever index they're using. Prepaid penalty. This says yes, as high as $3,000 if you pay off the loan during the first 2 years. So this loan had a prepaid penalty in this example. If it didn't have a prepaid penalty, it'd say no here. Balloon payment, no. And a balloon payment, I don't know if you're familiar with balloon payment. Normally those are a lower term loans, maybe 5 years, but you basically at the 5 years, the whole amount's due.
Yep.
So
You need to refinance it.
Scary.
Or pay it off.
Yeah.
30-year fixed is typically, you see mostly 30-year
Yes.
fixed now. So, but back in the day,
Oh, anything went back in the
yeah, everything
day.
today was adjustable rates, it was negative AMs, it was
15-year loans.
balloons, it was a lot of different stuff was going on. A lot of different types of loan products. And sometimes it still makes sense, but lately because the interest rates are so low, the price point you're getting on adjustable rate versus a fixed is not really worth it.
Not
Back in the
worth
day,
it.
it was worth it. You're
Yeah.
saving a lot of money if you're down here, projected payments. You got your principal interest. If it's mortgage insurance, it's giving you a breakdown of your additional escrow payments here. So what on top of your principal interest will be here? Well, it's telling you. Here you got mortgage insurance of $83.35 a month, and estimated escrows is $206.13. So they're escrowing for taxes, and then and homeowner insurance most likely. And then because this is telling you down here in years 8 to 30, well, they change this. Why does it change? Well, they expect you to have enough equity in the property that you'll see the mortgage insurance payment dropped off. So they kind of give you an idea. If this was an adjustable rate mortgage, they would show you beginning, and then 5 years later, let's say it was a 5-year adjustable rate arm, what the payments could be, either the low and high, because again, it's usually tied into an index.
So they put only 10% down, that's why they have mortgage insurance, right?
Right,
Up to
exactly.
20%.
Now, you'll notice that down below, estimated tax insurance and assessments, and below, $356.13. You see that? Well, you notice that the $356.13 does not equal the $206 and $82 here, because they're also adding in the HOA fees. Because let's say this was a condo, or this was a property in HOA, this is a monthly assessment. They're telling you here, hey, by the way, just realized, this is really, you have more to pay. Do you need a copy of this? Okay. Oh, you got it?
Even though they don't escrow it, they still disclose
They're
it.
disclosing it to
Yeah.
you, but they're not escrow. They don't escrow HOAs. At least most
Yeah,
places don't.
taxes and
I never see it either. So
insurance. Insurance and what's the
Taxes.
taxes?
taxes and homeowners insurance are normally what's done, and flood too if they're in a flood zone, and mortgage insurance if it's applicable is normally escrow. Again, down below you have your closing costs, and then you have your cash to close. Okay, and now this is going to relate back to page 2. This is where you start to get into the numbers. Give you an idea. So again, loan costs, section A, is going to be the hard costs that really can't, the zero tolerance bucket that can't change. This is what should have been on your loan estimate. It should match what they said here on your loan estimate. This would be your origination charges, all the fees that go to the lender to give you this loan. So here you have a quarter point, you have an application fee, and you have an underwriting fee. So that's their closing charges for that. That's the lender's closing charges. And you have services borrowers did not shop for. Again, these were also on your loan estimate, but they could change a little bit. Why? Because these are third-party fees. So this would include the flood determination fee, credit report fee, but these are other vendor appraisal fee. These are vendors that the lender is using to justify giving you the loan and running in search of the property. And then C is services borrowers did not shop for. And again, this would be your title company. So
Did shop.
Sorry, did shop for. And this would be your title company. So hopefully it's American Dream Title. So I just want to give a plug there, okay? Hopefully you're working with Susan. And these would be where their fees are. And Susan can give you a copy of what their closing fees are. Title insurance is promulgated. So basically that's going to be based on the loan amount or the purchase price. So that's not going to change. It's it's the closing fees that are going to be what you see probably different. And then D is the total loan cost. Okay, so realize there's borrower paid column, seller paid column, and then paid by others. So depending on who's paying for the item, it'll be in what column here. If you see at closing, before closing, well, before closing is like POC back in the day, paid outside of closing. It was paid prior to. Typically the appraisal is done like that. Any inspection fees, they're all paid up front normally prior to even closing. I don't know how it works for you, but I think I had to pay with a credit card for the appraiser to come out, the lenders, and they collect up up front for that. So that has to be
Sometimes
disclosed.
the survey too, sometimes.
And then the survey too would be paid outside of closing. Realize that on the closing disclosure is a federal form. It's a loan form. It's not a Florida form. It's not a title closing form. They charge here a little bit differently than how the promulgated rates work in Florida. This is a very, it's always complicated to
Confusing.
explain
Yes,
because
very
it's confusing how they do it here. In Florida, premium, title insurance premium is calculated if you're getting an owner's policy, you calculate actually on the purchase price. And then if you're getting a simultaneous loan policy, it's typically $25 minimum to charge. So it's almost like you get a break on the loan policy. It's only $25
Because you're having them issued together.
you're issuing them together. It's called simultaneous issue. You're issuing it together. And most people, when they're buying a property, they're getting an owner's policy and they're getting a loan policy. The form here does it differently. They want you to calculate the loan policy by itself like you weren't even getting an owner's policy. So basically you're calculating, you'll see insurance here based on the loan amount only, okay? And the endorsements to the loan policy or additional coverage. So they'll put that in section C, okay? Back in the day, it wasn't done like that. And in Florida, really behind the scenes, it's not done like that. It's calculated differently. It's calculated under Florida law.
We have a whole separate disclosure we give out at closing to explain the breakout, because it is very confusing.
It's confusing because federal law didn't contemplate that about 20-something states do premium differently. So,
there's a website like for Alta too where you can plug in the
Exactly,
numbers.
that is true.
And we have a training for that too.
and Kathy Brain, who prepared this presentation, has advised me that the House passed a bill that's going to the Senate that includes fixing the way owners and loan policy are calculated. So I don't know what the future
It's in
holds.
legislation, yeah.
So, but there's something going on in the federal government where they're trying to work this in, where you
So
basically
that it'll be more understandable.
in the different states that have these simultaneous, promulgated rules.
Yeah.
So, other costs. So when you're reading this and you're going over it with your buyer shows it to you and say, hey, can you, let's talk about it. Realize these are all loan charges, title charges typically.
Can agents give? You also have to tell something like it's not in the maybe better to talk with a lender first, right?
Well, yeah, they really should. This is the lender. This is something you should be talking to the lender for or their title company. Probably can best explain the charges and at closing they're going to go over this. But you're getting this in advance of closing, so you might get.
We get many questions on this. When the buyers first get it, it's confusing. So we will go through it. Because we do it every day, many times, so.
Yeah, so if you have questions, call
You can
Susan
send it
or.
to me. Yeah, absolutely. You can call me and I'll go through it with them, or we can do it over the phone together.
Yeah.
If I
Doesn't
want.
look too confusing.
And just be careful you're not giving legal advice. You want to make sure you're upfront with your client. You can't give legal advice on things, so you can go through it and try to explain it. And it's pretty self-explanatory. I don't think it's too hard. The premiums throw everybody off because it's not done like Florida.
Больше 5% получается closing business with purchase price. Это же хит.
Это если можно.
По-моему,
You guys following? Everybody following?
Anybody, questions?
Any questions up to this point? Any questions? Because I like to be interactive. I don't want to bore you and put you to sleep.
But I can send you guys the separate disclosure for the way that Florida premium is done, and it makes it a little more understandable, and like you said, they also too has that, so.
It's a mandatory form we have to in Florida to do with every closing. It shows the breakdown between the same price, paying the same price. It shows you how it's calculated in Florida versus calculated on the CD. Okay, so basically, other costs down here are your recording fees, your doc stamps, your mortgage taxes. Your prepaid would be your homeowner's insurance premiums, interest on the loan through the end of the month, property taxes, because remember that depending on when you close, these numbers will all change because they have to collect up front. And then you have initial escrow payments at closing because they want to start putting money into an escrow account to pay. Everybody knows taxes come out in November, right? In Florida. So if you're closing, let's say in this case, April, or let's say you're closing this month, nobody to collect, 4 or 5 months in advance.
Plus, they always keep 2 months in reserve as well.
Exactly. So that's why they're showing this here. They're collecting based on what month you close in. There'll be offsets from the seller too, on the third page, which we'll go over. But the lenders only cares about what they're going to be responsible for. They're going to be responsible come November to pay these taxes. They want to make sure they have enough at closing. They collect enough plus what they're going to collect each month to make that payment come November. Same thing with homeowners insurance. A year from now, or mortgage insurance, they want that money in escrow. initial escrow payments for closing, then other. Other is where you guys are gonna fall in. This is where your real estate broker commissions are gonna show. Just to give you an idea.
That's an important section.
Again, we cannot show you this at a title company. You'll have to get this from your buyer. Now, if they call and say, hey, you want to confirm the number, and say, I think you can confirm the number, and say your commission of blah, blah, blah is on there.
If the buyer authorizes it.
Yeah, or the buyer authorizes to show this to you, you can. But I think if the buyer doesn't authorize to show this, and they call you and say, hey, I just want to make sure my commission of this is on there, you can at least verbally verify, yes, your commission to Vera Realty of this number is on the
And
board.
9 out of 10 times the buyer wants you guys to have it because they want to be able to refer back. So a lot of times they will. Yeah, mostly they will. Unless they're really like nervous about their private information being out there. But most will.
So again, this is where you'll see HOA fees, you'll see certain, maybe, you'll see the real estate commissions, you'll see home warranty, home inspection fees, warranty, whatever. All these different other third-party fees that go along. Sometimes survey will be down here too, it could be in C, could be in H, depending on where the lender wants to put it. Different lenders are doing different things. I want to just explain that too. Susan can speak more on this, but different lenders are interpreting the law in different ways because there are some areas where it's a little gray. And I can't give you interpretation, even though it depends on how the lender's attorneys are interpreting it, how they're doing things, okay? The last part though is title, owner's title insurance optional. This is where the difference comes in. Remember I told you they charge for the loan policy here. If you're getting an owner's and simultaneous loan policy, the difference will be charged here, okay?
It's really strange how they break it out because on the old style HUD, it was all lumped on one line.
Yeah,
It was very clear. This is actually, it was supposed to be easier for the buyer. I think it's harder. Yeah.
And they do have the word optional here, so owner's policy is optional. Me personally, would I buy a property without getting an owner's policy? Absolutely not.
And the problem is if they quote opt out of the owners, which almost no one does, actually no one does, then their lender premium goes up because now you don't have that simultaneous discount.
We pay for the lender's premium only.
So it doesn't make any sense for them not to get both together.
And realize, if a lender would never give you a loan without getting a loan policy, it should, to me, speak clearly that, why would an owner probably buying the most expensive thing in their life, their most important asset, not get an owner's policy to cover them? And what an owner's policy does, if you're not familiar, it covers the past. It makes sure that you're getting legal title, the person selling it to you actually owns the property and is the 100% owner of the property, and that there's no liens, judgments, mortgages against that property that could later on be a claim against that property or interest in that property. So if you get an owner's policy, it's covering that you're the 100% owner of that property.
In the preliminary report, title report, do you guys provide that information too, like who was the past owner?
The commitment, typically what happens is a commitment is ordered, they send it out to the buyer and the lender and everything else, and the first page gives you kind of the breakdown of the transaction, the purchase price, loan amount, who we're planning on to who we're going to insure, which would be the buyer. If there's a lender, what lender we're going to insure, the loan amount. It gives you who currently the title is vested in. So if it's my property, I'm selling it to you, and we go off the public records. We're not looking at the contract. You might give us a contract and say, hey, the seller is John Smith. Well, if the last deed of record says it's Jane Smith, guess what? We're gonna the commitment's gonna say Jane Smith, and we're gonna go back to you and say, hey,
that's not your seller.
There's something wrong here. And we've had this happen. It happens a lot with an elderly parent passes away, and the son or daughter signs a contract with you, and they say we're the owner now. Okay, well, the last deed of record says John Smith, and we find that out in the commitment, and then we find out, hey, oh yeah, my father passed away. Well, guess what? Well, now there's other requirements that have to be taken care of. Probate has to be done on the father's estate. Depends on everything's case by case, but that's what the commitment will give you.
We have to record a death certificate. There's a bunch of things.
So normally the commitment, page A would be what the transaction's about. Page B1, the second page, will be all the requirements that need to be taken care of prior to us closing.
So that we can insure without an exception for these issues.
And
it's literally like your roadmap to the deal. It says, okay, this is what you have to do to clear up this title. Sometimes it's 1 page, sometimes it's 5 pages, depending.
Depends on what's going on.
But I mean, it's our job. That's where we come in. We come in and we start clearing those up, and we tell you up front, this is how long we estimate based on our experience to clear up these items. Sometimes they're clean, not very often, but sometimes.
Well, the typical things you're usually going to find is requirements you're going to see a deed from the seller to the buyer. You're going to see a mortgage from the borrower to the lender. Then you're going to see all the stuff that's pertinent to that particular search we did on that property.
Maybe a homeowner lien.
A mortgage gotta pay
So
off,
you
right?
mean-
Typically a mortgage gotta be paid off, we'll raise the mortgage, it needs to be paid off, that the current owner has on the property.